Let's bring in Lizanne Saunders, Chief Investment Strategist at Charles Schwab. Lizanne, it's great to have you here. Do you think that some of the Powell uncertainty and some of these huge nominations which are coming up and expirations of terms coming up plays into some of the market uncertainty right now?
Maybe a little bit. I think general uncertainty with regard to the Fed and the timing of tapering. But I think more recently, at least last week, the early part of the week, you certainly have to throw the concerns about Evergrande in there. And then this week, the move back up in the 10-year Treasury to 155 and the hit that provided for the longer duration, higher valuation segments of the market. And then, of course, the debt ceiling with that more definitive date that Yellen passed along. So I think those have had more of an impact in what we saw today in terms of weakness.
I remember asking you last week, Lizanne, post-Fed, why technology was holding up so well, given the rise in bond yields. And you said, well, if it keeps going, then let's watch. And that's exactly what's happened, is that it's kept going and technology has been dragged down. Do you see this as a long-lasting move? Is it going to be different than some of the other times that this has happened this year?
I think it's a little too soon to tell. When we hit the intraday low of down in sub 1.2, we felt that yields had overshot on the downside and that from that point, the path of least resistance would be higher. And clearly that's what we've seen. I think probably the next test point is that 174, which is where we hit on March 31st. And as you remember, we did have a 10% correction in the NASDAQ, and you really saw some of those higher valuation segments of the market take it on the chin. So I wouldn't be surprised to see some of those growthier areas stay under pressure while we watch this move up in yields. And we also have to remember that we've really exited a many-year environment where bond yields and stock prices were positively correlated, which was because we were in this disinflationary mode. And even in the early phase of reflation, before we had this inflation spike, the move up in yields was generally met with a move up in equities. But now we've reversed that to an inverse correlation because of this inflation backdrop. So I think that that's a very different environment in terms of backdrop for this market that equity investors need to be aware of. I think equity investors should always heed the messages from the bond market, but especially in an environment where that yield stocks correlation has gone to positive.
So are there any fears, though, Lizanne, that the buy the cyclicals, buy the banks because yields are rising is already too much of a consensus call?
Well, I would be careful that if yields continue to move up, but we don't get a commensurate boost in forward-looking growth estimates, if it's purely because of the inflation piece, then I think you probably see some of those cyclical areas run into trouble. I mean, it's no surprise to see energy is the only sector in the green today because of what's happening with oil prices. But there's also a lot of interesting things happening in the commodity complex, given that in the last week, you've seen an ascent in the dollar come in conjunction with an ascent in many commodities, not least being oil. And that it's only a week, but that's broken the normal relationship of an inverse correlation. So I think there's some kind of funky things, to use a technical term, going on under the surface in the past week or so.